Bitcoin is officially at a breaking point right now. For the past week, BTC has been trapped around the $77,000 range, barely moving, while the entire market waits for the next big move. But here's the problem. The longer Bitcoin sits under major resistance, the more dangerous this setup becomes, because behind the scenes, macro pressure is building fast. Bond yields are exploding. The Federal Reserve just turned dramatically more hawkish, and Wall Street is suddenly pricing in something almost nobody expected just a few months ago, a possible rate hike in 2026. Not a cut, a hike. And now, with Kevin Warsh officially taking control of the Federal Reserve, some analysts believe Bitcoin could revisit the low 60Ks before this market is over. Today, I'm going to show you why Bitcoin's current rally may actually be a trap, why altcoins could get destroyed if BTC loses support, the shocking Fed data most crypto traders are ignoring, and the one scenario that could completely invalidate the bearish case. Because, trust me, the next few months could decide the entire future of this crypto cycle. Quick note before we go further. Nothing in this video is financial advice. Everything you're about to hear is for educational and informational purposes only. Always do your own research before making any investment decisions. Now, let's get into it. If you're new here, welcome to the market continuum. We don't chase pumps here. We don't hype random tokens. We track the actual forces that move markets, the ones that show up in price weeks or months after the signal first appears. If that's the kind of analysis you want before the next major move happens, hit subscribe right now, because the window on what I'm about to describe may be shorter than you think. And one quick thing before we dive in. Morning, afternoon, or night for you right now, drop it in the comments. This audience is global, and I'm always genuinely curious where people are watching from. All right, let's build this out. Let's start with the honest technical picture, because there's a version of this that you'll hear on most crypto channels, and then there's the version that actually accounts for all the data. The version you'll hear on most channels goes something like this. Bitcoin is consolidating. Fundamentals are strong. The halving cycle is on track. New all-time highs are coming. Just be patient. And look, that narrative might eventually be right. Over a long enough time horizon, it's hard to argue against Bitcoin. But here's the problem with that framing right now. It completely ignores what the chart is actually saying, and it completely ignores what the macro environment is actually doing. So let's start with the chart. As of today, Bitcoin is trading below its 200-day moving average. That might sound like technical jargon, but it's one of the most important signals in all of financial markets, not just in crypto. The 200-day MA is the long-term trend line. When an asset is trading above it, the long-term trend is upward. And when it's trading below it, the long-term trend is either neutral or downward. And here's the critical detail. The 200-day MA itself has been falling since late April of this year. A falling 200-day moving average is not what you want to see. It means the long-term average price is declining. It means the trend is pointing in the wrong direction. That is not consolidation. That is a trend. Now let's add another layer. The Fear and Greed Index, which measures overall market sentiment in the crypto ecosystem, is currently reading 21 out of 100. 21. That is deep in extreme fear territory. Now the natural instinct is to hear that and think, that must mean a bottom is close. Buy when others are fearful. And sometimes that's true. Sometimes extreme fear does mark a bottom. But here's what that logic misses. In prolonged downtrends, driven by macro headwinds, extreme fear readings can persist for months, sometimes over a year. During the 2022 bear market, the Fear and Greed Index sat in the fear zone for the better part of 12 consecutive months. The signal alone isn't enough. You also need the macro environment to shift. And right now, the macro environment is moving in exactly the wrong direction. But let's finish the technical picture first. Over the last 30 days, Bitcoin has closed in the red on 17 out of 30 sessions. 17 out of 30 days, more than half the month. The 50-day moving average is currently rising on the daily chart, which is the one bullish signal in this setup. But on the weekly chart, that same 50-day MA is sitting above price and falling, which means it could be acting as resistance rather than support. The key support zone is between $73,000 and $75,000. Every time Bitcoin tests that zone, it holds. But every time it holds, it looks a little weaker, like a wall being hit by a battering ram. The first time, the wall holds. The second time, it holds. By the fifth or sixth time, the wall doesn't hold anymore. And if that 73,000 zone breaks on meaningful volume, the next technical level most serious traders are watching is somewhere between $60,000 and $63,000. That's a potential 15 to 20% move lower from current levels in a single leg. Now, does that mean it's inevitable? Absolutely not. But is it a realistic scenario given what the chart is showing? 100% yes Are you positioned right now, or are you just watching? Let me know in the comments, because your answer to that question matters for what comes next in this video. On May 15th, 2026, Jerome Powell's term as Federal Reserve Chair officially expired, and Kevin Warsh stepped into one of the most powerful economic roles on the planet. Now, a lot of crypto investors saw that headline and moved on. Fed chair changes aren't exactly the most exciting content in the space, but here's why that was a mistake. The identity of the Federal Reserve Chair doesn't just determine tone. It determines the entire direction of monetary policy for years. And monetary policy is the single most powerful external force acting on Bitcoin's price. Not technical analysis, not having cycles, not institutional adoption news. Monetary policy. So who is Kevin Warsh, and why should you care? Warsh served as a Federal Reserve governor from 2006 through 2011. He was in the room during the worst financial crisis since the Great Depression. He watched the Fed respond with the most aggressive monetary expansion in its history. Quantitative easing, near zero interest rates, trillions in balance sheet expansion. And when it was over, he publicly, explicitly on the record, criticized it. He argued that the Fed's easy money policies had distorted asset prices, created dangerous bubbles across multiple sectors, punished savers to benefit borrowers, and prioritized short-term market stability over long-term monetary integrity. He spent over a decade arguing that the Fed needed to be more disciplined, more rules-based, less reactive to markets, less inclined toward accommodation. In monetary policy terms, that makes him about as hawkish as it gets. And now he's sitting in the chair. Now here's what the market actually wanted from the Fed in 2026. At the start of this year, the consensus expectation was multiple rate cuts. Analysts were pricing in 2, 3, maybe even 4 reductions in the Fed funds rate. That would have loosened financial conditions. It would have pushed more liquidity into the system. It would have weakened the dollar. And it would have created the kind of risk-on environment where speculative assets, including Bitcoin, tend to thrive. That entire narrative is now dead. Since Warsh took over, markets have completely repriced. The current Federal Reserve funds rate sits in a range of 3.50 to 3.75%. And based on current market pricing, the expectation is now for that rate to stay exactly where it is through the end of 2026. Not 2 cuts, not 1 cut, 0 cuts. But here's where it gets genuinely alarming. According to the CME FedWatch tool and various prediction markets, there is now a meaningful probability being assigned to a rate hike before year end. Not a cut, a hike. Let me put that in context. 6 months ago, crypto traders were positioned for easing. They were leaning into a narrative of lower rates and more liquidity. Now the discussion has shifted to whether we might see rates go higher. That is a complete reversal. And that kind of reversal, when it happens quickly, is brutal for risk assets. Now here's why this is specifically dangerous for Bitcoin. Bitcoin doesn't pay a dividend, it doesn't generate cash flows, it doesn't earn interest. In financial terms, it is what economists call a zero-coupon speculative asset. That means its value is entirely dependent on investors believing the price will be higher in the future than it is today. When interest rates are high and investors can earn real returns from bonds or cash instruments, the argument for holding Bitcoin instead gets harder and harder to make. Every percentage point that yields go up increases the opportunity cost of owning Bitcoin. And right now, yields are going up. Now here's the part that changes the story fundamentally. What happens next is the real story. Because it's not just about Warsh's philosophy, it's about what the bond market is telling us Warsh might actually be forced to do. Most retail investors watch Bitcoin charts. Professional investors watch bond yields. And right now, Treasury yields are doing something that should stop every crypto investor in their tracks. Let's start with the 30-year US Treasury bond. This month, the 30-year yield surged to 5.121%. That is the highest it has been since May of 2025. And it is approaching levels not seen since October of 2023, one of the most stress-tested periods in recent market history. The 10-year Treasury yield, the most important benchmark in global finance, recently hit 4.595%. The 2-year, which tracks short-term rate expectations most closely, moved to 4.079%. Now, I want to explain why these numbers matter so specifically for Bitcoin, because this is something most crypto content completely ignores. When Treasury yields rise sharply, it means one of 2 things. Either the market believes growth is accelerating, or the market believes inflation is going to remain elevated for a long time. In a growth-driven yield rise, risk assets like Bitcoin can actually do well. Strong growth means more capital, more investment, more risk appetite. But that's not what's driving yields right now. What's driving yields right now is the second scenario. Inflation fear. The bond market is essentially saying, we don't believe inflation is under control. We don't believe the Fed has this situation handled, and we want to be compensated for that uncertainty. When the 30-year yield is above 5%, bond investors are demanding compensation for lending money to the U.S. government for 3 decades. That is a massive vote of no confidence in the Fed's inflation-fighting ability. And here's the part that brings this directly back to Bitcoin. Rising yields strengthen the U.S. dollar. A stronger dollar puts downward pressure on Bitcoin. A stronger dollar means global capital flows back into dollar-denominated assets. It means less appetite for alternatives. It means tighter financial conditions across the board. Now let's look at the historical pattern. The 2022 crypto crash, when Bitcoin went from $69,000 to $15,000, happened in one of the most aggressive rate hiking cycles in modern Fed history. The 2020 corrective phase corresponded with a period of sudden dollar strengthening. The pattern is consistent and clear. Tightening liquidity conditions plus dollar strength equals Bitcoin selling pressure. We currently have both of those things. Now, here's the part that even Wall Street veterans are talking about right now. Ed Yardeni, the man who literally coined the term bond vigilantes in the 1980s, came out recently and said that Kevin Warsh may be forced to raise interest rates specifically in July, not because of new economic data pointing to a booming economy, but because the bond market itself is demanding that the new Fed chair prove his credibility by demonstrating he takes inflation seriously. Bond vigilantes, for those who don't know, are large institutional investors who effectively punish central banks for loose monetary policy by selling bonds aggressively, which drives yields higher, which forces the central bank's hand. Think of it as the market sending the Fed a message. And right now, that message is being sent. If Yardeni is right, a July rate hike would land like a bomb in the middle of the crypto market. Hit like if this is starting to come into focus. Because we're building towards something that most crypto channels are completely missing. And what would you do if that July rate hike actually happens? Think about that seriously. Because there's a good chance that question matters. Now let's get into the inflation data itself, because this is where the 14-minute mark I mentioned at the beginning pays off. The data that's coming out right now is not what the crypto market is priced in. Let me walk you through the timeline. In early 2026, headline CPI was running at around 2.4%. That's almost exactly where the Fed wants it. Markets were celebrating. Rate cuts seemed imminent. Then March came. March CPI printed at 3.3% year over year. That was the highest reading since April of 2024. It shocked markets, and it immediately shifted rate cut expectations. But then April came. April CPI came in at 3.8% year over year. That beat the consensus forecast of 3.7%. It was the highest reading in 3 years. And it confirmed that what happened in March wasn't a fluke. We are in an accelerating inflation environment. Now, what's driving it? Energy? The conflict with Iran has sent gasoline prices surging over 18%. Fuel oil is up more than 44%. Total energy inflation is running at 12.5% annually. But here's the number that should be flashing red for every investor. The Producer Price Index for April 2026. PPI measures inflation at the wholesale level, what manufacturers and businesses pay before prices get passed on to consumers. April PPI came in at 6.0% year over year. The forecast was 4.9%. It came in more than a full percentage point above expectations. And PPI is a leading indicator for future CPI. Wholesale prices that are running hot today show up in consumer prices 3 to 6 months from now, which means even if energy stabilizes, even if the geopolitical situation improves, CPI could keep climbing through the third quarter of 2026. Now add this to the picture. According to Polymarket prediction markets, traders are currently pricing in a 100% probability that inflation stays above 3% for the rest of 2026. 100%, not a high probability, a certainty. And the JP Morgan base case, not some fringe bear prediction, the base case from one of the largest financial institutions in the world, is for the Fed to keep rates steady through the end of 2026, with inflation still elevated. Now, here's the layer that almost nobody in crypto is talking about. The inflation we're seeing right now isn't just energy-driven. Shelter costs are remaining sticky. Food prices are edging higher. Core services inflation, the type that is most resistant to interest rate increases, is showing virtually no sign of cooling. And here's the most uncomfortable data point of all. Real average hourly earnings declined by 0.3% over the past year. Wages are not keeping up with prices. Consumers are getting squeezed. Purchasing power is eroding. When you combine slowing real wage growth with persistent inflation and high interest rates, you get an economic environment called stagflation. Slow or stagnant growth combined with elevated inflation. That combination is historically one of the worst environments for speculative assets. It's also one of the hardest for central banks to navigate. Cut rates and you risk inflation spiraling higher. Keep rates high and you risk crushing economic activity. There is no clean move available to Kevin Warsh right now, and Bitcoin sits at the intersection of every bad outcome in that equation. Now here's where the story takes its first real twist, because there's a scenario playing out inside the Federal Reserve right now that could completely flip this narrative. And it's the piece almost no one in this space is watching. Before I get to that twist, I need to talk to the altcoin holders specifically, because the altcoin market is sending signals right now that are genuinely dangerous for anyone who isn't paying attention. Despite everything I've just outlined, altcoins have been pumping. You've seen it. Tokens up 20, 30, 40% in a matter of days, influencers posting screenshots of gains, Telegram groups and social feeds calling the alt season, the narrative that Bitcoin's consolidation is the calm before the altcoin storm. And here's my honest assessment of that narrative. Some of it is real. There are legitimate projects with genuine fundamentals building right now, AI infrastructure tokens, high-performance layer 1 chains, real yield protocols with actual revenue and user bases. Those projects may well outperform over a full cycle. But here's what that doesn't account for. Timing. Because historically, altcoins do not outperform in weak Bitcoin environments. The relationship is simple but brutal. When Bitcoin drops 10%, most altcoins don't drop 10%. They drop 20, 30, sometimes 50%, because Bitcoin is the base layer of liquidity for the entire crypto ecosystem. When institutional and retail investors want to reduce crypto exposure, they don't sell their altcoins first. They sell Bitcoin. Bitcoin price drops. And then altcoin holders start panicking. And then altcoins collapse. This pattern has played out the same way in every major drawdown this cycle, and the previous cycle, and the cycle before that. The dynamic doesn't change because a project has good fundamentals. In a liquidity-driven sell-off, everything gets sold. Now here's the part nobody is paying attention to. A significant portion of what you're seeing in the altcoin market right now could be exit liquidity. Let me explain what that means. When large players, funds, early backers, whales want to exit positions, they don't just sell into thin air. They need buyers on the other side. So the pattern often works like this. A narrative gets engineered or amplified, a coin or sector gets talked up, charts look beautiful, retail FOMO kicks in, volume surges, price pumps, large players sell into the pump, and then the music stops. And the retail buyer who chased the 20% pump is now sitting on a position that's about to drop 50%. This is not conspiracy theory. This is documented market structure. And it happens most aggressively in exactly this kind of environment, where macro is deteriorating, smart money is reducing risk, and retail is the last optimistic participant left. Share this with someone who needs to see it before it's too late. Because the people who get hurt most in these environments are the ones who bought the altcoin pump 2 weeks before Bitcoin broke support. Comment below if you're currently holding altcoin positions in this market. And tell me your thesis. I'm genuinely curious whether people are seeing this risk. Now for the twist, I promised you. Because this story isn't just bearish, and if I left you with only the bear case, I'd be doing the same thing I criticize other channels for doing, giving you a one-dimensional picture. Here's the scenario that could completely invalidate everything I've just shown you. And it comes from an unlikely source, Kevin Warsh himself. Here's what the market isn't pricing in. Despite Warsh's hawkish reputation and his history of criticizing easy money, there is credible analysis suggesting he may actually be laying the groundwork for eventual monetary easing through a very specific mechanism. The mechanism is a change in how inflation is officially measured. Instead of the traditional core PCE model that the Fed has used for decades, there are signals that Warsh may push toward placing more emphasis on what's called trimmed mean inflation. This methodology strips out extreme price movements on both ends of the distribution. Under this framework, inflation appears significantly lower than the headline CPI number. Now here's why that matters for Bitcoin. If the Fed changes its primary inflation benchmark, it creates the political and analytical space for the Fed to declare victory on inflation even while headline numbers are still running above 3%. And if the Fed declares victory on inflation, the justification for rate cuts comes back. And if rate cuts come back, liquidity comes back. And when liquidity floods back into the financial system, Bitcoin doesn't just recover. It historically accelerates at a pace that catches most people completely off guard. That's the bull case. But here's the catch. Before we get to that pivot, we may need to go through a period of maximum pain first, higher yields, possibly a rate hike in July, Bitcoin testing lower support levels, altcoin positions getting wiped, more fear, more capitulation, more retail investors giving up and walking away from the market entirely. And then, right at the moment of maximum pessimism, the narrative flips. That is how every major Bitcoin recovery cycle has begun. The question is not whether that recovery is coming. The question is whether you'll be positioned when it arrives, or whether the interim drawdown will have already forced you out. Subscribe if you want to stay ahead of what's coming. Because the moment this narrative shifts, it will shift fast. And the channel where people track macro before it moves price is the channel that matters right now. Let's bring this all the way home. As of today, the 23rd of May, 2026, Bitcoin is sitting around $74,000 to $75,000, below the 200-day moving average, in extreme fear territory, trading red on more than half the days this past month. And it's sitting inside a macro environment defined by April CPI at 3.8%, a 3-year high, 30-year Treasury yields surging above 5%, a hawkish new Fed chair with 0 rate cuts expected this year, a meaningful probability of a rate hike on the horizon, PPI running at 6%, a full point above expectations, and bond market pressure building in ways that even Wall Street veterans are calling alarming. The $60,000 scenario is not extreme. It is not fringe. It is what the data is actively pointing toward in the short term. But here's what I want to leave you with. Every major Bitcoin bottom in history has looked exactly like this. Not safe, not obvious, not comfortable, scary. The investors who made generational wealth in this space were not the ones who called every pump correctly. They were the ones who understood the macro forces deeply enough to know the difference between a temporary breakdown and a permanent one, and who had the patience and the clarity to stay positioned through the storm. That's what this channel is built to help you do. Not to chase, not to hype, to understand. So here's my question for you, and I want as many responses as possible. Do you think Bitcoin revisits 60,000 before this is over? Or do you think the bulls hold 73,000 and this entire move resolves into new all-time highs before year end? Drop your prediction in the comments. Tell me your reasoning, and tell me what you're doing with your portfolio right now. If this breakdown gave you something the mainstream crypto channels are not giving you, share it with someone who needs to see the full picture before the next move happens. Subscribe to the Wealth Continuum, because what happens next in this market is going to move faster than anyone expects. And when it does, you want to already understand it.